Hello guys, and welcome to the golden rules of the Block Party Pro strategy. This is basically a rule set to help give you the edge and to take an already good and successful strategy to a higher win rate and, more importantly, to a higher target profit. These are all little things that you can do that are not complicated. You do not need to be an experienced pro trader in order to do so. It is simply trade management and also just being a little bit more conscious of what's going on in the market at the time. So to kick off with the first one, always look for the best possible entry. For this, we're going to be using this trade just here as an example. And what we can see is if we see this take profit, it ends up going and it misses just here. There are a few things we can do throughout the course of this video. I can show how to turn this trade into a winning trade. The first one is, as we spoke about, the best entry possible. As we can see here, the trade comes down here, up there, and it continues upwards in its trajectory, but then it retraces. Now this is quite a common occurrence for price movement, especially with these signals. The price will often go up and retrace a little bit. Now, it doesn't always happen, but as you can see in this example just here, it does. It retraces and goes back down. But not all times that happens. As you can see here, it comes down, nice entry, and it just continues up. So this can be somewhat of a double-edged sword, but we'll show you a nice little method as to how to actually go about getting a pretty good entry most of the time. So there is one very important rule here. Never, ever, ever chase an entry. Which means, as you can see here on the entry point, the price just goes straight up. So don't try and enter here, 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 because what will happen is you basically have to keep the risk reward the same. So if we use our stop loss, we put it just down here, and we stick to the advised 1-to-1. And you end up all the way up here. So you can see this dramatic increase in your take profit in order to attain this 1-to-1 risk reward. That is something we desperately want to avoid. What we do want to do is try to enter anywhere between the stop loss and the entry. That is the ideal scenario. So what do we see here? Well, you can just simply wait. You can do one or two things. As the price shoots up, you can place a limit order just here, and you can wait for the price to revert, which it would have done it. It would have actually got tagged just there and picked up. Or you can play it a little bit more cool, and you can wait until the price starts to come down a little bit more, and then somewhere in and around this region just here, there is a pretty nice little area where you can look to enter. Let's take a look at the trade structure and how it changes just on such a small difference in this entry. So let's say hypothetically we managed to get a pretty good entry just down here. We'll use our stop loss that has been signaled by the actual indicator on the positions tool, and we'll use the 1-to-1. And lo and behold, we can see that the original trade here, as signified by the indicator, has unfortunately just missed. But then the updated or better entry, we can see, has nailed it. There are a couple of other things you can do. So you can actually maintain the same take profit. In that sense, you'll be increasing your risk reward. So you'll take, for example, if you're using a 1% risk here, you'd make 1.29. Alternatively, you can even reduce your risk. So in this scenario, I think that would be around about a 0.66% risk. And with this take profit, it would make you 1%. But like I said, you know, this has missed, but it's just an example of what you can do with a better trade entry. So don't always rush to enter the trade. Sometimes it is actually a bit better to wait. In that last point, we also covered to never chase an entry, which is golden rule number 2. Those two basically go hand in hand. On to number 3, which is always limit in, try to limit out. And this basically is more directed towards Bitcoin and also crypto trading. On such exchanges at the moment, like MEXC, we have incredibly low fees. In fact, the maker fee is 0% and the taker fee is 0.01%. But in most circumstances, the taker fee is 0.06% and 0.02%. So that isn't, for all of it, that is just one way. So the best case scenario in these trades is that it will be 0.04% to limit in and limit out. Or if you're a bit lazy and you wanted to mark it in and mark it out, then it could be up to 0.12%. Now that sounds absolutely tiny and like it would make no impact whatsoever. However, unfortunately, you would be wrong. So if we were to take this trade just here, for example, we're looking at a target of 0.24%. And as we know, we have a full target of 0.24%. So 50% of this trade is going into fees. So if you're standing to make $50, then you're going to be paying $25 in fees. And the real kicker here is it works inversely on your stop loss. So instead of losing $50, then you'd actually be losing $75. However, on the flip side, if you were to flip that around and look to use the 0.2%, then you'd be looking at a pretty small 0.04%. Instead of losing half of your trade, you'd be losing around about 15%, which, to be fair, is still quite a lot. But it can be mitigated by making sure that you navigate around exchanges and you make sure that you're using exchanges which may have offers on, promotions on, or you have great affiliate links with, in order to get these fees as low as possible. Now, this, granted, is one of the smaller targets that you'll generally see with Bitcoin. Around about 0.3 to 0.4% is the usual target. So when you're looking at 0.04% of a 0.4% TP, that is quite tiny, it's 10%. And then for the most part, you're looking at trades very similar to this at 0.6%, which it really does have a lot less impact on. But unfortunately, there are some limitations. You can always limit into a trade, and I would always advise that. However, you can't always limit out. On stop losses, it is highly advised to use market orders for the sheer safety of them in case the price barrels through. It's a trade that you do want to get out of. And sometimes on limit orders as well, the same thing can happen in that they can get wicked and unfortunately they cannot get filled. However, if you are monitoring them manually and watching them closely, then always use limit orders to get out of them. It will make such a huge difference to your P&L. On to golden rule number 4, TPE, which is a little acronym for take profit early. So I personally have a rule of when the trade makes around about 80% of the profit, then it is looking like a pretty good place to start thinking about taking profit or at least raising your stop loss. So we're back to using this trade again. As we can see, we know that this trade, unfortunately, it didn't quite reach take profit. However, if you're not going to use a better entry, then there are other things that you can do to secure the profit. As we can see, the price went up and it filled probably around about 90%, maybe 95% of the entire trade entry. However, what we want to really be doing is if we are monitoring this trade, when it reaches around about the 80% margin, so let's just say 80% is here, well, let's do it by eye, it's not the end of the world. In fact, that's actually bang on, there you go. So 0.8, then we can just move the stop loss up to break even. And then we're running a nice risk-free trade. Unfortunately, the trade doesn't quite meet where we originally were, which is just here. But there are other things. So personally, what I do is I am quite happy to, if I'm monitoring the trade and watching the trade manually, I'm quite happy to take profit anywhere between 80 to 100%, because at the end of the day, you're securing your profit. You are day trading, you are scalping, and market movement, any kind of minor market movement, announcements or news can dramatically ruin your trade in just one candle. So sometimes less exposure is more valuable than waiting to take that extra 10 or 20% profit. This next point is regarding crypto more than anything. So when you are trading with crypto, it unfortunately is the victim of lag because you have different options that you can use to trade. You can trade on TradingView if you want, using this little trading panel down here. You've got all of these wonderful different exchanges that you can use. They're great. You can use some smart trade platforms such as Annie, which is easily the best smart trade platform going, but unfortunately it suffers the same downsides which any API-based platform will, which is lag. So with lag comes slippage, and sometimes your trade entries can be a little bit late. So when you're scalping, it is important to be as accurate as possible. Therefore, I always advise that you trade directly on the exchange. Now, unfortunately, this does come with its downsides because they are a little bit prehistoric compared to smart trade platforms, but they do also have the most up-to-date pricing and the fastest execution, which is what you want. Now, as you are simply using an entry, one stop loss, and one take profit, there really should be no issues with doing this. Now, let's move on to FedWatch. So you can go to anything like cryptocraft.com or Forex Factory, and you can get a handy little calendar like this. You can find the link in our Discord. And we also put out notices and alerts for every time these things come up, and also 10-minute before and 2-hour before alerts as well. These will always cause volatility in the market. And unfortunately, what happens there is when you're in a trade, it doesn't really matter if it's the best technical analysis in the world. When this kind of volatility comes in, it turns your trade into pretty much a coin toss. So personally, what I advise is to close out all of your trades about an hour or two before these notices start to come in. Head on over to this website and start to get a little bit of an understanding as to how this is going to impact crypto. So if we take a look here at the US CPI year on year, all we have to do is click here and we can see that actual less than forecast is good for crypto. So we just wait for this to come in and we can get our trade ready and set up on the chart or on the exchange or on MT5, and we can basically try to just trade it manually because we have a higher chance of success doing it this way versus relying on technical analysis. So if you're a little bit unsure about that, then simply just don't trade because it is going to be volatile. Next up, we have one of my favorite pastimes, which is backtesting. So backtesting is essentially as it sounds. You have a strategy and you may be on the gold on the 3 minute. Backtesting is as it sounds, and it is the foundation of how we decide which strategies are good and then go forward into live testing. So simply with backtesting, all you are doing is you are going back in time on the chart to any chosen date or period or time frame or asset really, and just starting a bit of a tally of how many wins versus how many losses. If you want to employ different strategies, maybe increase your take profit, reduce your stop loss, see how it is when it reaches the 80% of take profit, moving stop loss up. And you can just start to note all of these down yourself. So before you start doing any different strategies in a live trading scenario, I always recommend backtesting at least 50 to 100 trades to get a bit of an idea. Is this a go? The more trades, the better. And I certainly recommend it if you are going to trade anything but gold or Bitcoin, to make sure you do a thorough backtesting before you start deploying any live funds. As we have tested these, we weren't terribly happy with the results. However, we have not tested every single asset in the world, and we have not tested every single time frame in the world. So you may stumble upon a bit of a gold mine, and if you do, of course, please let us know. However, we have always found that gold and Bitcoin on the 3 minute has been, well, quite simply the best. It is extremely easy to do. You can actually get an app which is a tally counter. That's one of the easiest ways to do it quickly. Or you can do it on a really granular level and log every single trade on an Excel spreadsheet with a screenshot. The choice really is up to you. Whichever kind of data sets you are most satisfied with is the way to go. There is no definitive way of doing this. Just because you have more data, it doesn't necessarily mean that you are going to learn more about it, because at the end of the day with strategy like this, it is simply a win or lose strategy. But when you start to integrate different factors such as moving stop losses, reducing TPs, increasing risk rewards, then yes, it does start to get a bit more complex, and you do have to get a little bit more accurate and granular with how you go about backtesting. However, if you are trying a new asset, new time frame, then it is mandatory. The next one we have here is number 8. Always give your stop loss a bit of a buffer, and don't be afraid to adjust it to market structure. So what I mean by a buffer is that with our algo, the stop loss will be based on the exact point of the most recent swing high or most recent swing low, and the default, it only looks back the past 15 candles. So it is important that you sometimes cast your eye over it. And usually what I'll do is, if there is no significant pre-high or low or point that I think should be paid attention to in price action, which we'll have a look at these two in a second, then generally I'll just give it a small little bit of a buffer like that. And that'll help kind of, if the trade comes up and it just touches this support or resistance just here, resistance in this case, then it should hopefully give you enough to go down. If it breaks that, then there's a good chance it will continue on. But the downside there is, as you increase your stop loss, you also increase your take profit relatively. So just be conscious of that you don't end up increasing it to such an extent because you are paranoid it's going to get hit, that your take profit just becomes a little bit unachievable. We can see that the price has then gone on and tagged this stop loss, and this is where we're at. But the reality is, as to what I would do in a scenario like this with such a small TP of 0.05%, then I would not be unwavered about looking to these two swing highs just here. So we can quite clearly see that from this point here, we start to have 1, 2, and 3 significant touches on this resistance. So therefore, I'd take the top one, which is just here, and I'd apply the same logic, and I'd add my stop loss to that with a bit of a buffer. Naturally, like I said, I'd have to increase my take profit, so it's relative to that 1-to-1 default, but that is really not a huge increase. So all in all, I'm quite happy with that setup. And as we can see, we just narrowly miss this touch on it there, and we can see there's 1, 2, 3, 4 touches on this resistance before the price starts to drop. So always give your stop loss a bit of a buffer, and always be conscious of previous swing highs and swing lows. Now we'll just take a little look at this scenario here. It's quite an exceptional scenario, but this is one of the limitations of mechanical algorithms versus the trader's eye, which you do have to be conscious of. As we can see with this trade here, which we've looked at a couple of times before, unfortunately it didn't go on to hit take profit, but again I will show you how to be conscious of making sure that your stop loss is in the correct place in order to turn this losing trade into a winning trade. So we can see just here we have a swing low, and we can see just here as well we have a swing low. But if you also see where the take profit sits, it is actually to the bottom of this candle. The reason why that has happened is because that we only have a look back of 15 candles, and we look for the lowest or highest point within those 15 candles to define where the stop loss is going to go. Now the algorithm of this basically will always be following a swing high or swing low, and it is just kind of how it works. If you look at really any trade, we can see it goes down, up, and then that's where the trade comes in with this precursor of a swing high, swing low, and again just here, swing high, and so on, and so on. Unfortunately, that one goes up, but hey, you can't win them all. So we always know that there's going to be a swing high or swing low pretty nearby. In this occasion, you can actually have them so that the swing highs and swing lows are quite close together. And what that will cause is basically it tries to look far enough back that it'll take this low point of this candle as the lowest. Now, there is no significant price action going on here, which means that it's kind of no man's land for a stop loss. The reality is your stop loss should realistically be going somewhere like here, which is quite an obvious nice bit of support, or all the way down here. So you have two options. One, you can put your stop loss there, or one, you can put your stop loss there. Now, personally, when I'm looking at this, you have to take a few things into account. If you put your stop loss, we'll just take the entry as we would see it. If you were to put your stop loss all the way down here, as you know, our TP will have to be relative to that, which puts it a whopping great high up here, which is big on an already relatively big trade for scalping. However, if you look here, we do actually have 1, 2, 3 touches on this support, which is now a support, and then also it brings our TP quite nicely down. And then we now have turned this trade from a loser into a winner where it hits just here. So just be a little bit mindful of where your positions box is telling you to put your stop loss, because occasionally, not very often and very, very rarely, as you can see, it nails it there, and pretty much foreseeably on a large majority of all the other trades. But again, it is something just to be conscious of. Next up, we have take profit adjustment, and we're back on this trade on how to turn this loser into a winner. So already we've identified that with adjustment of your entry, you could have turned it into a winner. Adjustment of your stop loss, you could have turned it into a winner. Being on top of your 80% limit, you could have turned it into a winner, or at least break even. There is one other way which you could have done it. So when we look at this trade and we take it as it is seen on the actual entry, we're not going to adjust that, and we're not even going to adjust the stop loss. We're just going to take it as seen. Currently, our take profit is in line with where the positions box is telling us to put it. And if we continue with that, we're not going to make that profit. However, what we should be doing is looking a little bit backwards as to see what is this telling us. We have a pretty obvious resistance here. And again, we have a pretty obvious resistance there. So unfortunately, our support and resistance zones won't always pick these up. So it is always worthwhile making sure that you do a bit of kind of due diligence on your support and resistance structures yourself. It's not terribly hard to learn. As you can see, it is literally looking for a high point or multiple high points that are touching. So what we can see from this trade immediately is that we're actually going to hit some resistances. Now, this isn't uncommon. And the further down the resistance, the more we kind of have to ignore it, because unfortunately, if we were to abide by this resistance, it brings our risk reward down to 0.66, which in my opinion is too low. So we basically just have to hope that the price is going to smash through there, because the momentum of the price is moving that direction, which it does ultimately. However, this next one is actually quite significant. As we can see with the actual price, if we were to align our positions box, our custom positions box with it, it ends up with a 0.9. Now, we already have a rule in place where anything past around about 80% we're relatively happy with. So that means that if we are going to be tackling a resistance at anywhere above 0.8 or 80% of our entire trade, then we should be a little bit mindful that we might want to conserve and secure profit before then. So what I do, and what I have done in the past, and what I continue to do, is if I notice scenarios like this where my positions box is suggesting that I place my take profit just on the wrong side of resistance, I will always bring my take profit down to just below, inversely to how we operate with the stop losses. Instead of putting it just over, we put it just under, because a lot of other people will be putting their sells just there. As the price goes up, lo and behold, we can see that this resistance is tapped, and big sell-off. In fact, such a big sell-off that it actually goes to stop loss from there. Just by paying attention a little bit to what's going on around you, you can make sure that you're giving your trades the best possible chance of not getting their stop losses hit, making sure that you are improving your entry, and also improving the chances that your take profits are going to get hit, and also that you're going to close in profit as well. So next up is talking all about risk. Risk is an absolute mandatory item for any kind of strategy. So by risk, it is basically making sure that you are essentially losing the same amount per trade, whether it's 1%, 5%, 10%, instead of investing a fixed amount per trade. Because 9 times out of 10, you'll be using variable stop losses. So with a fixed amount in there, a 5% stop loss won't be as bad as losing a 10% stop loss. Whereas with a fixed risk, a 5% stop loss will be exactly the same as a 10% stop loss. However, these can be actually quite hard to figure out unless you've got automated systems in place to figure them out at all, really, let alone when you're trying to do it quickly. I've got 2 systems which I use, one which is for crypto and one which is for Forex and trading gold. The first one with crypto is on the risk calculator. You can get the download link on our Discord, and this really is as simple as it needs to be. So if my total allocation that I have in my futures account is $1,000 and I want to risk 5% per trade, and my leverage is going to be 200 because MEXC offers it, at the end of the day, leverage is pretty irrelevant providing you're operating to a solid risk reward and also stop loss. and my trade stop loss is going to be 1%. It means that in order to ensure that it limits my losses to only $50 per trade, which is 5% of 1,000, based on a 1% stop loss, that means that I would have to use $5,000. Because when the trade goes down 1%, I would lose $50, but when it goes up 1%, I would make $50. And that's pretty much how it works. There's a quick cheat sheet here if you just want to have this up. So if your trade is at 0.9, then your total needs to be 5,556. And if your trade is at 0.2%, you'd need to put 25 grand into it, which sounds like a lot, but at the end of the day, you will only lose $50. And next up, you've got a slightly easier system, which is using the Trade Assistant. You can find the links to it on the Discord or on our website. And you can very, very easily just set your risk per trade at 1%, your risk reward at 1 or 1.1, whatever. And all you have to do is you basically just move your stop loss into position. So my stop loss is down here. This moves along with the actual price. And if I'm to close this, I can just simply hit place. And it means that it will automatically work out my TP of where it needs to go in order to maintain that 1 to 1 risk reward or 1.1 risk reward. So I highly recommend the Trade Assistant. It's so easy to use and it is so fast and accurate. And then last but not least, golden rule number 11, which is simply have a target. So with have a target is, what is your daily target? Is it looking at 1%, 2%, 3% per day? In whichever case, then you pretty much use that as your target. Generally, the way that this algorithm works is it's kind of like a profitable seesaw, in that it will go win-loss, win-loss, win-win, win-loss, win-loss, win-win, win, win-loss, win-loss, loss, win-loss, and so on. And you're kind of constantly seesawing, but gently into profit. However, occasionally you do hit really perfect trading conditions for this algorithm, and it will sometimes win 3, 4, 5 in a row. And sometimes you will enter your trading day during that winning streak. And if you do, it really is best advised to take that and then put down the tools and leave it for the day. Because statistically, it will balance out and it will start to probably incur some losses on the way. Now, not to say that this resets at midnight every night and this is not being able to tell the future. However, statistically, it's what I've noticed from trading personally myself. Whenever I've been 3-4% up on a day and I've continued to trade, I seem to have always ended the day trading on around about 1% or 2%, which is still great, but it is also quite annoying when you are up that much and you could have just stopped trading for that day. Providing you are aiming to not lose, then it really is a very good method just to maintain that profit, and also you don't have to trade all day. If you're in profit and you've met that target in the first hour or two, then great, take the rest of the day off. Anyway, that is all of our golden rules, and they will only increase and more refinement will come. But in the meantime, make sure you join our Discord and hang out in the dojo, which is where we talk about this indicator all day and strategize amongst all like-minded people. It's a really cool place to be, and you can learn a lot there as well as ask us at Block Party any questions that are plaguing you, and we're always on hand to give you some help and advice.